Hello, my name is Gene Schwartz. If you're as tired of the political rhetoric on many critical issues as I am, take a few minutes to explore them with me. We are fiercely divided over concerns about big government, greedy bankers, and the assault on religious freedoms. This makes compromise seem impossible, gridlock unavoidable, and solutions unattainable. If we lay aside preconceived notions and examine available evidence, we may find common ground on which to rebuild our economy, fix our broken government, and restore our endangered values. Let's begin by considering the issue of debt. The world is run on money. Most of us cannot buy a home or car or get a college education without access to credit. Over the past decade and a half, banks have showered us with easy credit, often with misleading and fraudulent solicitations, without regard for our ability to repay. Declining wages and rising living costs made us easy targets. The perverse incentive is that riskier loans pay a higher return to the investors who buy them. Banks can simply jack up interest rates and fees on all customers to cover defaults. If the economy crashes, taxpayers will be forced to bail them out. It is a form of socialism, not capitalism. It works similarly with governments. Nations borrow to finance their infrastructure projects, military hardware requirements, business support activities, disaster recovery, and other needs. International business interests promote the projects to governments, and international bankers promote the loans. Only Taiwan and tiny Liechtenstein have no external debt. Other countries do. When their ability to pay is threatened, social programs are often blamed. But nations without social safety nets are also deeply in debt. Fiscal irresponsibility must play a part, but we should not overlook international investors' love of government debt. Neither the lenders nor the borrowers will allow default on the loans, which are often guaranteed with taxpayer money. The bankers do not lose their own money. Most nations never get out of debt. Lenders impose austerity programs requiring them to cut government spending, adopt free markets, privatize their infrastructure, etc. Spending cuts produce unemployment and lower disposable incomes. Business revenues and profits decline, and inevitably so do government revenues. In simple terms, austerity produces recession. Recession is defined as a reduction in gross domestic product, or GDP. There are several formulas for calculating GDP. Some use personal income, while others use personal expenditures in their calculations. These numbers are from 2007, before most of the financial meltdown, but the ratios for other periods are similar. Personal expenditures and government purchases represent 90% of GDP. It should be obvious that any significant reduction in either must cause a recession. You can pause this video to study the tables and charts more closely. Cutting spending in a recession reduces personal income and GDP. Inevitably, lower personal income equals lower consumption, equals lower employment, equals lower GDP, equals recession, equals lower tax revenues, equals more debt. It is basic mathematics. Debtor nations could raise taxes to reduce the drain, but personal taxes are already too high, and no one wants to tackle the real problem, corporate taxes. Corporations have revenues or sales 3 times that of personal income, yet individuals pay 14 times the federal income tax as a percent of revenues. Large multinational corporations take advantage of tax havens, special tax breaks, and subsidies, so pay little or nothing in income taxes. Their economic power gives them disproportionate political clout, which makes it virtually impossible to level the playing field. The supply side argument is that corporations are job creators, so their taxes must be kept low. However, it is a question of which came first, the chicken or the egg. Corporations do not build facilities or hire people in the absence of demand. Demand comes from people with adequate disposable income. Record corporate profits are doing little to create jobs now because high unemployment and underemployment have reduced demand for their products and services. I believe we must completely redesign our tax system. In the meanwhile, the only alternative is to raise taxes on those who can afford to pay more. When the Clinton administration raised the top income tax rate from 31% to 39.6% and raised the minimum wage, unemployment fell from 7.5% to 4%, corporations experienced record profits, and the United States ran budget surpluses for 4 years totaling $559 billion. Only government can refuel an economy during deep recessions. Once the economy is healthy, taxes can be cut, but they should be cut gradually. I am not advocating high tax rates, but temporary higher taxes are necessary to minimize debt in times of recession, war, or national emergency. Lower personal taxes can increase disposable income and stimulate demand, but they can reduce government revenues and increase debt. Their effect is short-lived and limited because cuts in progressive tax rates, which are highest for the highest earners, benefit the wealthiest most. Those who must spend everything they earn to survive get little or no savings from the cuts. This table shows the tax savings at different income levels from a hypothetical 10% across-the-board tax cut. The average tax saving for the bottom 50% of taxpayers is only $46, certainly not enough to lift the country out of recession. Tax savings of the already wealthy are parked in long-term passive investments, government bonds, etc. Money tied up that way becomes lazy money. It increases their wealth, but adds nothing to overall economic activity. The disparity in income and wealth is now about as great as in 1928, just before the Great Depression, when the top income tax rate was 25%, the lowest in the past century. Large tax cuts since have all been followed by recessions. The 1971 recession came after a cut to 70%. The 1982 recession followed immediately a cut to 50%. The same is true for the 1988 cut to 28% and the 2001 to 2003 reduction from 39.6% to 35%. Rather than creating growth, tax cuts merely drove up the national debt. Money saved on taxes became lazy money, much of it invested in government debt to be repaid with interest by taxpayers. Steady economic growth in the U.S. occurred after World War II, when the top tax rate was 91% on incomes over $400,000 and income gains were broadly shared. That $400,000 might be $5 million today. Businesses avoided the higher tax rates by increasing wages and benefits, investing heavily in research and development, and expanding their facilities. They priced products and services to maximize volume. As businesses grew, government revenues did too, standards of living rose, and unemployment was low. Economic and political power was more broadly shared until the 1970s and 1980s, when the flow of business money into politics increased spectacularly. The Great Depression occurred under lax regulation of the financial sector. This chart shows the decrease in bank failures from newly imposed banking regulations during the Great Depression. This chart shows the increase in bank failures after deregulation in 1980 to 1982. Deregulation of the financial sector destabilized the economy. In 1980, banks were given free control of interest rates and how they invested depositors' money. Investing in risky and fraudulent ventures resulted in more than 2,000 banks failing, requiring a massive government bailout. Congress obviously had not learned from that experience. In 1995, they passed the Private Securities Litigation Reform Act. It made it more difficult for shareholders to pursue legal remedies against corporations and investment firms putting out false information. In 1999, they passed the Financial Services Modernization Act. By repealing the Glass-Steagall Act, it lowered the barriers between commercial banks, investment banks, and insurance companies, allowing banks to become so large they would not be allowed to fail. In 2000, it was followed by the Commodity Futures Modernization Act, which prevented regulation of derivatives, and by eliminating position limits on futures trades, allowed speculators to drive prices up outrageously on petroleum and other commodities. Oil and natural gas and their byproducts consume a significant part of our disposable income, are a major contributor to recessions, and have been used as a political tool. 3 of the last 4 recessions were preceded by dramatic increases in oil prices during presidential campaigns. By 1980, the average annual price of oil had increased from a monthly average of $15 to $37 per barrel. By 2000, it had gone from $12 to $27. By 2008, it had risen from $58 to $91. By mid-2012, it reached $93 per barrel, signaling yet another potential downturn. Money thus taken out of consumers' pockets becomes lazy money. Regulations created during the Great Depression were stripped away by politicians elected to serve our interests. They will not do so unless we take back our government by reforming the financing of political campaigns. Each year, lobbyists representing special interests with very deep pockets funnel billions of dollars to our 535 senators and congressmen. In 2009, that amounted to $3.5 billion, or an average of $6.5 million for each of them. Who do you think they will listen to, you or the special interests? Politicians of both parties depend on their largesse to get reelected. The Supreme Court has exacerbated the problem by considering money to be speech and corporations and organizations to be persons in their Citizens United decision. It should be 1 man equals 1 vote, not $1 equals 1 vote. I urge you to check these facts for yourself. I have examined from a politically neutral perspective many of the issues confronting us to see what the truth is on taxes, healthcare, Social Security, immigration, public welfare, abortion, and other issues. The results point toward a number of potential solutions. I would like to share them with you. They are in my book, Megamyths of Politics, Economics, and Religion. It is available in print and ebook formats from Amazon.com. Thank you.